You're listening to the DistressedPro.com professional interview series, where we bring you actionable advice from professionals on the front line of today's real estate and mortgage note market.
Welcome back, everybody, to another episode of the Distress Pro Professional Podcast Series, where I interview folks who are really in business in the front lines of today's real estate market, including the note investing business, and folks who work with lenders and buy and trade notes and REO and foreclosures. And today I've got Abby Shemesh. I said it right?
You did.
Okay, great.
Yes.
I've got Abby Shemesh on here. He runs Amerinote Xchange, and maybe you can, I don't want to say you run it. I'd like to get some more details from you on that. But here's what I'd love to do is a lot of folks who listen to this, some of them are in business, a lot of them want to be in business and are starting off in business. And I would love to just talk a little bit about how you got into the note business. Maybe if we could talk about a couple of deals, if we could, and sort of where your business is at today, what kind of notes you're buying, and that sort of thing. We'd walk through that, and then maybe a couple of case studies on a couple of deals you've done, something like that. If we just chat loosely about them without too many details, that'd be great. So tell us how did you get started with Amerinote Xchange? When did you open? How did that whole thing come to fruition for you?
Well, thank you for having me. And yes, absolutely. So I was in the loan origination space in the big, subprime boom, right? So got into originations in '99 as a junior loan officer for a company in Pennsylvania, which was licensed only in Pennsylvania. And through that evolution of career, I guess you could say, we, kind of branched out into other spaces of residential commercial originations. We did a lot of subprime and conforming and non-conforming, we'll call it, nowadays referred to as non-qualified mortgage loans. That lasted until about 2004. And just to be perfectly frank, one day sitting in our office, when Bear Stearns was still around, we had our account rep from Bear Stearns come in and introduce us to our new account manager and said, "Hey, I'm going over to acquisitions." And that's when what's acquisitions? What are you talking about? And they explained in great detail how banks also purchase loans and sell loans off and so forth and so on, which led me down a path to research the back end of the secondary mortgage market. And that's how I discovered the note buying space.
Cool. So, so did you just jump right off from there? Were you getting product from that, or how did that?
No. So to continue the story, got out of origination, started doing research in the acquisition space. That was late 2004. Got out of originations. Started researching and building a plan, trying to find, getting the sense of how to source leads. So from 2005 to the end of 2006, really did a lot of my research, and there wasn't a whole heck of a lot out there at that time. Brought Amerinote Xchange, founded Amerinote Xchange officially in the end of 2006. Started with the website, got the lead gen going, and we kind of slammed right into the 2008, financial crisis, when we were really getting some lift in our industry, in our business.
Yeah. Now, when you first started that, was this your plan? It was an acquisitions company. Did you start with capital, or how did that?
That's a good question. We started with the sheer idea of wholesaling loans, brokering, I guess you can say at the time.
Yeah.
And taking those proceeds to use as a stepping stone to start buying. Now, what we found out very quickly is that there was the players that were in the industry were not as prevalent, not there wasn't as much saturation as there is today. So there was very few, investors that were buying. There were, a lot more deals that we were seeing in the seller finance space than we were on the institutional banking side.
Yep.
But we did get our share of both of those types of leads that came across our desk. So we did not have capital per se to start, but we built up capital very quickly in that period of time.
Yeah. Cool. So, so walk me through that a little bit more. This is back 2006. You've got partners or don't you? And then bring us through, if you would, today. So
absolutely. So this was kind of I don't want to say a one-man show. We definitely had a partner involved, and is still involved. She's my partner now, and one of the co-founders of the company, Molly Corson. Also my wife. So she, we kind of took the bull by the horns here, and we're just trying to generate as many leads as possible. And we were wholesaling, we were referring notes off, we were, buying what we could, capital partnerships and joint ventures with who we could at the time. But we were seeing that there wasn't a lot, the cost of capital was much different. The sentiment in the market was much different back then. So, wholesaling started off ferociously doing very well in 2007. And then right around February 2008, we started seeing a tremendous slowdown, which came to a screeching halt in October of 2008. And then from there, honestly, from October 2008 to December of 2009, I didn't have one single yes. Not one single yes on any offers that we were making, whether we were trying to buy for our own portfolio or wholesale off. And it was a very, very challenging period, a very challenging time in the industry.
Oh, yeah. I mean, I had just opened a commercial real estate brokerage, like a boutique investment firm, and our transaction volume dropped by 97% that year. So yeah, that was definitely a tough time.
Yep. And I may add that even for the most prettiest performing loan, we weren't seeing offers or making offers higher than 65 cents on the dollar because we were running into huge equity deficits, on these BPOs that were coming back way under for many, many months and years.
Yeah.
All the way up to, it didn't really level out for us. And we didn't really see a change in the market until September of 2010, when appraisals started kind of, cooperating, we'll say, with the transaction.
Yeah.
So that's really where we saw that. And, places like Miami, I don't know if you recall, but that time, Miami, toxic. Florida was toxic. Nevada, Las Vegas, toxic. At those times, everyone was allergic to these areas.
The condos there, especially. I remember I had a good friend of mine who I did a lot of business with in the mortgage space, and he had just gone long and like an upper floor condo on the beach in Miami, and was totally wiped out down there. It was pretty bad. Yeah.
Devastating. Texas was, didn't really see too much swing either way. So that was still kind of safe, but the offers weren't, generating any interest. And then of course, California was a bloodbath, starting with Stockton, all the way down to the Inland Empire, like, San Bernardino, just toxic. And then we started slowly but surely seeing small areas that were not necessarily affected by the real estate downturn and wild price swings starting to come back. Offers were being accepted, money was flowing, deals were flowing. And then it was just a roar back, 11, 12, and the rest is history.
Yeah, right. So, so talk a little bit about, if you would, what kind of deals you're buying, and what's your business model today? Are you like clipping coupons? You're just buying for income, or are you rehabbing these, or what's that look like?
That's a good question. So our strategy, we have multiple buying strategies across the board, depending on the assets that we're reviewing for purchase. Our primary strategy. So we operate a great deal in the seller finance space. Now we have multiple marketing apparatus where we kind of cast a wide net, marketing net, which captures not just seller financing leads, but we from time to time get leads from asset managers that will reach out to us specifically, a couple times where they turned out to be very fortunate in our ability to capture those leads. But what we're seeing a lot of are these, poor, because credit score sensitivity comes into play a tremendous amount when you're trying to achieve par or close to, which is, as close to the unpaid principal balance as possible, which a lot of these institutions and seller financed lenders are looking to achieve. So we see a lot of poor credit, good seasoning, good, decent equity loans where we would rehab the borrower to either, collect payments over the life of the loan, compounding interest and so forth and so on, or we would rehab we would buy low, buy as low as we could, rehab the borrower's credit as much as possible by placing them with a loan servicing outfit that reports to the credit bureau. So assuming that they're making all of their other payments on time, which is kind of a risk, maybe 12, 18, 24 months down the road, we just took a loan that we paid 62 cents on the dollar for, and now we can turn around and wholesale it if we want for 92 cents on the dollar. Or we can continue collecting, our 11.5% return on investment. So there's different strategies, exit strategies there, because we like to keep our options open, because as we learned in 2008, and now with the oncoming, what I call the Great Depression of the 2020s, which is in route, at least from what we're seeing, and based on the research that you provide from your great platform, we need multiple strategies here. We can't just paint ourselves into a corner and go, hope for the best. That's a surefire way to lose money.
It's hard to have a crystal ball right now with the weirdest economy ever, but it's also hard to see how, all of this stimulus, between the PPP and the direct payments and the eviction moratoriums and the foreclosure, more like it's definitely a severely distorted market right now. And when these distortions go away, it's going to be interesting to see what's underneath,
I agree 100%. I feel like we're in one of those mirror fun houses.
Sure.
Where, you're
look
looking
all nice and skinny and
right.
extra attractive.
That's right. It's very that's a good explanation there. I will say though, if you don't mind me continuing on,
yes, please.
That is our primary source of that's our primary strategy. But we also have strategies when it comes to like non-performing, sub-performing, reperforming, which I don't love reperforming notes. I know some people do. We'll also do, deeds, which come through our seller finance marketing arm. We'll do lease options. We actually have a capital partner who's hungry for lease option contracts, which is basically the acquisition of the property, not necessarily the note. So there's different strategies that we provide, but not least of all, the non-performing bank paper that we're seeing. And, that's the typical strategy that there's a lot of outfits out there that are following that strategy. It's very effective and it's very lucrative if done correctly and modeled correctly. You don't just close your eyes and put your finger on a map and go, here's where we're going to do it. You really have to put the research in. And again, I know this is from personal experience. This is where the platform that you operate is, priceless. The information that we get there.
Appreciate that.
No, for sure.
So one of the things I'm hearing you say, and I'm glad, a lot of times when I'm talking with folks, they want like a secret formula or one answer for how to make money with these things, but it's really not that. It's really about being able to source the deals and then figure out ways to make money with those deals, isn't it?
That's exactly right. So I'm going to just kind of take a couple steps back. And this is what, we did a lot of speakerships, spoke to, folks who are trying to get into the business, folks who are in the business, folks who are landlords trying to be buyers, folks who are, real estate agents trying to be note brokers. Here's the deal. you may not have capital. You may not have, a rich uncle or capital partner that has money to just step in and buy. What do? Your seat at the table comes through your ability to generate leads. That is your currency. You are at the front lines and you are in charge of who gets what lead. In essence, you're going for the one that makes you the most money. In some cases, you're also going for the ones that make you the most money in the future, depending on your investment strategy. You may not need that wholesale fee now. You may need, incoming, payment stream in the future.
Right.
So there's different ways you can slice this up. And I always say, your currency is the leads.
Yeah.
That is the money that you're bringing to the table. So you don't necessarily need $100,000 in a self-directed IRA. You may just need a $12,000 marketing budget per year that you can dump in SEO or pay-per-click, or I know pay-per-click can be a lot more expensive, but SEO, if you have the right tools and the right team, you may be spending $12,000 to $36,000 a year. And that's really all you need to generate $500,000 in fees.
Or if you don't have that, then you're dialing the phone and you're sending emails, right?
Exactly. Through a subscription, like a service like yourself.
Yeah. Appreciate that. That's a lot like, in commercial real estate, which is where I've got, a lot of friends and colleagues and, where I spent a lot of time. It's very similar in that you start off as a broker, but after a while you participate, and maybe you don't even participate with cash. Maybe you throw your commission in and now you've got a little piece of a building over here, and, that kind of thing. And so it really does take being a student of it all and being, flexible and smart enough to evaluate what's kind of coming across your table.
And I learned a lot about the underwriting. So as an originator, you want to pump them out, you put them through loan processor or desktop underwriter, or, you try to, pump them out as quickly as possible and you move on. I learned a tremendous amount of information and strategy through the underwriting process of, especially of our institutional buyers, what they accepted, what they didn't accept. In many, many years, you're on the front lines, you start learning how to buy them correctly. That's the difference between being wiped out in a recession or a depression and not. I will say, and I'm not bragging, it's not, there's still plenty of time for this to go wrong. But as of today, of this recording, our entire in-house portfolio, not once have we received a request for a delayed payment or a foreclosure in any of this, because I feel like we bought correctly. And I feel that that's a big part of it. Now, we've had conversations about what would happen. And again, there's plenty of time. These moratoriums start expiring when? In March, I believe.
Soon.
2021. Soon. Yep. So there's definitely time and things but as of today, we're over a year into this, just about a little under a year into this mess. And we have had no issues. And I attribute that to paying the right dollar amount, not jumping on every lead that comes your way and thinking that you're going to be, because just because it's good on paper doesn't necessarily mean it's going to play out that way. You need to talk about the human element. You need to talk about the emotional element if you're dealing in seller financing, because in seller financing, what I learned is that lender is emotionally attached to that asset, and I think, if I'm not mistaken, I may have even, I'm sure you're familiar with this, the institution or the asset manager or the loan officer, whoever you're dealing with at the credit union or the bank that you're buying from, they're not. They're not emotionally attached. They may not even be price attached. They're more attached to how long is this going to take for this to happen? How much work do I have to put into this? Process, I guess, is really what they're interested in.
Yep, exactly. Process, timing. And then probably the number after that.
The number after that, for sure. The number does play a role, but you start really seeing the landscape and reading the terrain of the different avenues that one could take to benefit from the back end note business, whether it's institutional or seller financed. And I know we're hyper focused on institutional here, and we have plenty of experience in that realm as well, but they are two different strategies.
Yeah, sure. I like to say that, and I didn't make this up, a good buddy of mine, Mike Carey, whom I worked with for a long time and I've interviewed on this show, I think first said it to me, but lenders are repeat, non-emotional distressed sellers. Like you can't find that anywhere else. There's no private seller who's a repeat non-emotional distressed seller. You know what I mean? Like that doesn't exist. So that is why I like working with them too. Much more numbers than a process person, and, care much less about, people's personal attachment to their assets, and how to navigate that. Yeah.
And there's a lot of emotions. I'll say this and I'll kind of end it there, but when you're dealing in the seller finance space, you are sometimes more than just a lender or an investor buying a note. You could be a family therapist if you're dealing with some sort of inheritance dispute between siblings, which is a big reason why these seller finance folks sell notes. Or even sometimes, dad bought a note from the bank and now dad's gone, and the junior and junior are fighting over it. So there's definitely levels of experience that come along with the strategies that you choose. So, but let me tell you, and to everyone who's listening out there, this is not there's work involved in this for sure. There's no get rich quick here.
Yep. I don't think there's any get rich quick anywhere, right? Unless you're in Bitcoin or GameStop, right?
I was just going to say,
your timing's perfect.
Cryptocurrency or GameStop's another one.
Yep. Well, so tell me a little bit about, or tell our audience a little bit about, who should contact you. You're running this business over here. What's a good match? A lot of folks listen to my shows and they want to reach out to the guest, and I want to make sure that we've got, they've got a good understanding of whether or not they should, and when they do, what it's about, how you work.
Understood. Absolutely. We do get, I'll start by saying what we don't do, if that's all right.
Sure. Yeah. What
we do not do is provide broker education. We get a lot of requests for education. I'm looking to get into the note business. I'm looking, we want to figure out, how to get bank deals and, so forth. Can you show me how to do that? And that's not what we do. What we could do, and what we do, a good candidate would be I don't care your level of experience. Myself and my team will hold your hand through your first transaction, as long as you have that currency with you, those leads. And I'm not talking about lead gen that you pluck off of, a website and pass off as your own, because that's not going to get anywhere very quickly.
Yeah.
We're talking about cultivating and harvesting your own leads, either in the seller finance space or a relationship with a bank manager, where you would be at the forefront of that conversation. You will be right there with us when we do the negotiation, when we do the processes, and you'll see, if it is your first transaction, exactly how we do it. So you can take that, scrub it, use it as your own, wash, rinse, repeat, and move on. And then hopefully you'll bring us more deals. We live in reality, so we understand that we may just do a couple deals with you and that may be it. But we are more than willing to work with new folks that have the leads, that have that lead generation.
Yeah. So someone gets a live one, they can contact you, and you'll help them make money with that.
Exactly. We'll do, the first thing we'll do is we'll identify what it is, the goal is, of not just the person selling the note or the entity selling the note. What does the broker, we'll call it, or the wholesaler want out of this? So we're really going to touch on that. I know a lot of folks that are new to the industry, or maybe not. Maybe they're just don't have so many deals under their belt. They're very hesitant to give up that information because they think they're going to be circumvented, and that's a good a good stance to take. The last thing that we are looking to do is to circumvent anyone, because we need that wholesaler, we need that broker front and center. Because that's, we don't have the we're not a large, institution. We don't have the bandwidth to do that. So we actually, it's a symbiotic relationship there. We'll identify the goals. We'll get on the phone with the seller. We'll put the broker in the driver's seat if they so desire. If they're not comfortable with that, we'll put ourselves in the driver's seat, with them in the passenger seat, and give them all of our secrets to negotiation, everything, because we have nothing to hide in that sense. We're not looking to monetize that. We're looking to buy notes, get compounding interest, and arbitrage in some cases that those proceeds, in other cases looking to create payment streams or assets that we can sell.
And so the way that I assume the way you participate in whatever the fee or whatever the strategy is, whatever the return is on that.
That is correct. And in some cases, we have some very successful situations where you had mentioned, look, you don't take a commission. We call that a deferred commission, right? So you defer the commission for a piece of the note down the road, or you defer the commission for a piece of the property sale once we foreclose, which can be 10, 20x what you would get. You're going to get a $10,000 fee, or you can have a $100,000 piece of this asset if and when it sells.
Right, 18 months.
There's 18 months. It depends on the investment appetite and the goal of the source bringing us the deal.
Yeah, cool. So selfishly, what I'd love to touch on before we wrap up here is I know you've been a customer. I know you've done some lender direct deals. I wonder if you could just sort of talk about what that's looked like for you when you're dealing direct with an institution, and sort of maybe if you could just paint a picture of what's one of those deals that went down.
Yes. There was 4 that come to mind. Now we have our list that we cultivated, and we're nurturing that into transactions, ever growing. Some subtract, some take away, some add. We've had 2 of them that come to mind that were a culmination of there's no, and I'm sure that you know this, and I'm sure that in the training that I've seen on your platform has been mentioned, follow-up is required. It is everything when using it's everything in any kind of marketing. I'll give you an example. In the direct mail lead, right? Whether you're selling refrigerators or note buying services, they say that the average person needs to see your mailer, 5 to 8 times before they really start sinking in. Well, guess what? Those numbers apply to asset managers that you're reaching out to at banks, and you can't shower these people with gifts, right? That's a big no-no. You want to make sure that you're doing this in a way that's professional and that plays by the rules. And what I'm getting at is it took many polite, persistent follow-up calls, emails, visits to some locations in some cases, that finally gained the trust of some of these institutions that provided us, one of them, up to 7 months of just feeding us deals. These weren't large banks, right? So we're talking about small banks are the target market here. You do not knock on the door of Wells Fargo and expect to get a response. Even medium-sized banks of the Bank of the West, and even smaller. So we were targeting credit unions. We were targeting small banks. May had 1 or 2 here. It's great experience. Get your feet wet. Get a feel for the cadence that occurs in this type of process when you're dealing with institutions. And it's just a tremendous platform that's been very good to us. This required follow-up, it required email, required phone calls. Once we got that and we built that and established that trust, we were fed deals. I mean, some of them were just one-offs, right? So credit union just had 1 or 2. I remember taking both of them under commitment. One of them went through, the other one didn't, for appraisal reasons, and there was some back and forth that it just didn't pan out. There was another institution that had statute of limitation seconds, which were so hard to place, right? I mean, these SOL statute of limitation seconds, we had a buyer that was eating those up. That's something that we wouldn't buy personally. We had an institution that provided us with statute of limitation loans. It was one of our biggest trades we've ever, and it was solely from the hard work that we put into using a tool like Bank Prospector, which is, I don't know of any other out there that comes close to providing the level of information. What we see and what we hear, especially in this industry, is we run into a bunch of people and businesses and institutions, specifically independent folks, who say, "Oh yeah, Bank Prospector, heard of it, used it, not really, and didn't really have any luck." And I'm not saying that that's the overall experience.
Yeah.
What fails to be realized here is the work that needs to be put into cultivating and harvesting a marketing strategy. The marketing strategy, you can outsource it and to a company, and maybe they'll perform. There's nothing like what Bank Prospector offers on the market.
Yeah.
The level of information and intelligence that you can glean from this very reasonable, I think reasonable platform, subscription-based platform, is volumes of what it can be in business, especially if you get just a couple banks that continuously feed you deals that you can service those leads. It could make your half a decade of business for you in not having to, you can cut marketing budgets, especially if you want to hyper focus on that. I know folks that get into this for the specific purpose of buying seconds and rehabbing them, non-performing seconds and rehabbing them. I know folks that are getting into it for the acquisition of just vanilla non-performing firsts that went awry, resi. I personally like the non-accrual. I like the weird ones. I like the construction. We can actually do, we have an investor that will do non-collateralized business debt, which is a big one. So there's a tremendous amount of opportunity, especially off the weird ones, construction loans, industrial, gas stations. These are big ones that no one's really paying attention to.
Yep. I have a lot of good gas station stories actually from selling notes and that kind of thing. So, well, geez, man, I really appreciate you coming on here. And if you're listening to this and this sounds like it makes sense to you, and get out there and start finding some deals. And then when you get a hold of one, give Abby a call over at Amerinote Xchange.com. And he'll walk you through the whole thing, make sure that you make your money. And you're going to learn a lot. And Abby, I really appreciate you coming on here today and talking. I appreciate you being a Bank Prospector subscriber. And I know everybody who listens to the show appreciates it when folks come on here and they share, the real deal. So thank you for that.
Thank you for having me. I greatly appreciate the opportunity, and I greatly appreciate the product that you put out there. It is second to none.
Thanks, Abby. Amerinote Exchange, check Abby out over there, and visit us at DistressPro.com. Hey, this is Brecht Palombo, founder of DistressPro.com. Are you ready to take your real estate or note business to the next level? We'll show you how to start sourcing discounted and distressed off-market deals direct from institutional sellers. Visit GoBankDirect.com today and learn how to take control of your deal flow and profit in any market. Go now to GoBankDirect.com.